Normally, bookkeeping hardly sounds like a topic that can excite an entire generation in the way that blockchain has. But at its core, blockchain is a bookkeeping method, albeit a very innovative one. Throughout history, record keeping in the financial system was based on either one of two methods: single entry bookkeeping and later double entry bookkeeping. Many of you will already be familiar with the bookkeeping, but let's do a quick recap of how it works. It's important for us to know these basics so that we can understand the fundamentals of blockchain. Single entry bookkeeping or single entry accounting is the simplest form of accounting, characterized by the fact that only one entry is made for each transaction in a journal or transaction log. The single entry approach is very similar to what you would see in your personal bank account that keeps track of deposits, withdrawals, and balances. Entries are recorded either as a positive or negative amount in a single column. This method fundamentally keeps track of only the bare essentials required to determine one's financial position. In single entry bookkeeping, you can actually keep a two-column ledger, one column for the revenue and one for expenses. It's still considered single entry because there's just one line for each transaction. Double entry bookkeeping, on the other hand, generates at least two equal and offsetting entries. Each account has two columns, a debit side and a credit side, and each transaction is contained in two accounts. For each transaction, an entry will be made on the debit side of one account and the offsetting entry will be made on the credit side of another account. By design, the double entry system will provide several forms of error checking such that any inconsistencies will indicate that account histories include an error. Because each transaction generates offsetting entries, the total value of debits should equal the total value of credits. A double entry system works so that the balance sheet equation always holds. Assets equals equity plus liabilities. An example of a double entry transaction would be if a loan is received from the bank. The cash account would be increased by the loan amount, and this would be the debit. Then the double entry increases the liability owed by crediting the relevant account. Essentially, a single entry system will track revenue and expense accounts, whereas a double entry system will track asset accounts, liabilities, and equities accounts. As financial systems have become more complex, the simplicity of the single entry system has restricted it to use in recording low volume cash-only transactions. Single entry accounting provides insufficient records and insufficient control for public companies and other organizations that must publish audited financial statements. Globally, double entry accounting is the standard for recording all transactions. It permits results to be reported on an accrual basis. This gives owners and managers crucial and more accurate information for evaluating the financial position. For centuries, there has been little fundamental innovation in how we keep financial records. The blockchain has changed this and offers us exciting new ways to use ledgers to enable innovative solutions to some of the most fundamental problems in finance today.